Hey guys, Gary Cardone here. I have a really interesting entrepreneur, Brian Anderson, with me today. He is involved in building a business in the digital asset industry, what I call the digital asset industry, to get away from the words like crypto and confused terminology. Brian is leading the show at Raze, and rather than me really like botching up what Raze is, because it's a very unique, I think, how would I say it? It's a very good indicator of where we're headed into the future for how markets work. And I think the type of business model that he's building is very relevant to what we're doing. It's called Raze Finance, RAZE Finance. Please follow Brian. Whether you like him or not, follow him, because I like him, and the community is going to get bigger by us, hitting these buttons. Okay, it's a way to send messaging to the algorithm so that our community is growing. We can be more impactful. So Brian, really, really good to have you here. It's been about a month since I've seen you. Last time I saw you, I think, was in a restaurant. We might have had a little tinky drinky. And I've always enjoyed hearing your story. So let me just kind of give you the floor. Tell us who you are, where you came from, and what you're doing with Raze, and what's Raze.
Yeah. Thanks, Gary, for having us. I've enjoyed getting to know you as well. I think we first had breakfast down in Austin, Texas, for the Consensus event, and one of my partners was with me, and really just enjoyed the time with you. I got to commend you first and appreciate you for being one of the loud voices in this industry. And one of the first things that you said to me was, let's stop talking about the technology, and let's start talking about like what are we doing? What problems are we solving here? Right. So I appreciate that kind of candor. We need more voices like that. I founded Raze about a year and a half ago, and I pulled together a whole bunch of smart people around me that came from a lot of different industries, but we all had one thing in common, and we had been involved in startups most of our careers. I started, my career just coming right out of the gate in 2002, and my first job was a startup, and I've literally just worked in startups my whole career, 21 years. So I love it, and that was one of the things that led us to develop Raze. And obviously, it's a little bit of a play on words, with RAZE. If you know what that means, go look it up. It's a fun word to kind of think about, but I think a lot of this is going on. A lot of old structures that were currently in place are starting to either be brought down and rebuilt, or we're rethinking new things. And that's one of the things we're doing at Raze is we're really ultimately building an operating system to deploy capital and raise capital differently. I looked at companies like Shopify and think about e-commerce prior to Shopify. If a business owner wanted to go start a business, it was on e-commerce. It was virtually impossible. So all the big boys kind of came into e-commerce initially. Now anyone can start a business, whether they should or not is a different story, but anyone could sell something online because of what Shopify has done. I have a mission to do the same thing with raising money, which is why we started with a really big sector to go after, which is companies raising pre-seed to seed rounds, which is arguably one of the largest kind of areas in private placement capital raising, but also the most underserved area of 100,000 plus companies fighting for capital on any given day. And so we looked at that and said, how can we reduce the friction to go to market, reduce the cost to go to market, not have to go through, I mean, if anybody's tried to start a company and raise money, the thought of having to hand over what little money you have in your bank account to an expensive attorney or a fundraising consultant or a broker dealer is like makes you sick, because you're like, I just want to get this thing off the ground, right? And most of the time, even when you spend that money, it doesn't work anyway. It doesn't work out. So we really thought, how can we use technology today, not just Web3 technology, but innovative structures, things going on with AI, any innovation right now, use tech to make things cheaper, faster, and better to go to market for a startup. And then on the reverse side, how can we make investors have a better experience? How can we make it safer? How can we give them better due diligence long term? And ultimately, is there a way to actually provide better liquidity for private investments? Can we ever get there? And lastly, what I'll say with Raze is one of the things that I get excited about, although we're not there yet because we're still expanding our product, is I always think about, if I can, it's been 20 plus years since E-Trade and public markets went really full-blown digital. And if I can open up an app and trade in 2 clicks of a button on E-Trade or Robinhood, why is it so darn difficult to do something in the private sector? Like, why is it so high friction? And I think you know the answer. I know the answer too. But we got to do better. And so there's been no technology innovation in 2+ decades in private placement. DocuSign has pretty much been the only innovation. And so we're fighting to be one of those solutions to really improve access to capital for companies. And I think you're muted, by the way.
Yeah, thank you. So your client is the entrepreneur like you that's trying to raise money to put fuel in the business's tank so it can take it through the journey. Is that correct? Just like you'd go to a banker and say, hey, I'd like to raise $5 million. The banker then spends a year getting you all prepped up and beautiful. That'll cost you a bunch of money. And then you may or may not be able to go to market at that time and raise the money anyway. Is that so? You're basically replacing the role of the investment banker? Is that?
I mean, that is a really bold way to say it, but absolutely, we're trying to provide a faster, better way. We know democratization of capital is happening before our very eyes, so we're part of that solution. Yes.
Yeah, I mean, when you say that it's you never said it that way. I mean, I think it's that. Look, I think that we're moving into Web3, and Web 1 and 2 did very, very, very little to disintermediate any type of finance. Okay, actually, banking, finance, Wall Street all expanded because of e-commerce. Like Visa, MasterCard, all these people have gotten fat from the e-commerce structural change in the way consumers buy their toilet paper. And I think your position is, hey, look, if they can buy toilet paper from anybody in the world, they should be able to buy. And if they can invest in Bitcoin through intermediaries, and they can go to Robinhood or they can go to E-Trade, why hasn't technology shown up here to reduce the cost of going to the market and the time for guy raising money? And it's an extremely painful process. It takes the guy's eye off the ball of his core business, and he spends most of his time answering questions from 22-year-old kids that don't even know anything about the industry, and they're learning on your back, right? That's a problem. I mean, in fact, one of the companies that I have a big investment in, I think we're raising money. I don't think we are raising money. I think we have that business on your platform, if I'm not mistaken.
Correct.
Yeah,
exactly.
Yeah. And I'll tell you, the economics are compelling. Okay. The economics are, well, I think, Brian, you've made it almost impossible for somebody saying that they want to raise money, almost impossible to say no, quite frankly. Your offer is extremely generous, taking a lot of risk out of the equation on the front end, all the heavy lifting work that goes into putting one of these packages together. I think you've removed a lot of that work from the management team. So that's good value.
Thank you. Yeah. And I'll add this too, after doing hundreds and hundreds and hundreds of demos and prospect calls with founders over the last year and a half, the same answer kept coming up. And, we all know as entrepreneurs, you listen to the market, you listen to your customers, and the same answer came up regardless of whether somebody was in a seed plus stage or an early stage friends and family round. And that was, yeah, I know some investors, or I have a couple of checks that have come in, or I've raised a lot, but I'm out of investors and I don't know how to find new investors yet. There is a wealth of contacts online, free, paid for, doesn't matter. It's really not the fact that they can't find them. It's that there's too much information. There's too much data to mine through, and the founder doesn't have time to figure out who they should be pitching to. And when you have a venture firm that puts money into early stage companies, they tell us this, that they are seeing roughly about 1,000 pitch decks a month. You have no chance.
Wow.
And so what we came out with just recently in the last couple of months was a dedicated investor relations service, an IR service. And we've actually split it into two different ways. One, do it for you. Got a team that goes out and they're your IR guys and they book you meetings based on your profile.
Brian. That was the only thing I saw missing. And you promised me that you were going to add that. That was really smart I didn't expect you to do it that quick. I think that's going to be valuable to the user.
Yeah, it was something we really had in mind for a while, and it just was finding the right people to get it done. And then the other side of it, and this rolls out next month, is we are incorporating using automation light AI to actually go out and with your LinkedIn profile, your account, and email, be able to, with our database and our partners' databases, go out and actually find you the right kind of investors. Kind of do it with you model versus a do it for you model. Definitely a cheaper version, or a more affordable version, I should say. And we think that completes the cycle for us while we continue to build and innovate on the tokenized security side on the back end, which is going to do a whole bunch of cool stuff early next year. But we had to solve those blocking and tackling things of making it cheaper and faster to do an issuance, to raise money, making it cheaper and faster and more accessible to find investors, and then ultimately provide a more effective way to outsource that and get some help from professionals to go help you find more investors. And we're still early and we're still small, but we think we really can capture the market with that kind of message.
Well, that may be a good place to ask the following question, which is, how big is this market? And I think the way you would look at it is seed. Maybe we explain to all the people. I think sometimes these conversations get rigged with a bunch of nomenclature. Seed or pre-seed is really early stage money, almost no revenue, maybe just an idea, right? Then it goes to A round, 10, 12, $15 million. You have revenue. Then B, C, D, and E. I've never understood the whole B, C, and D and E thing, but I figure if you can't build a business on the first couple of rounds, like, at least start generating some money, man, some income. But if I have a 12, let's say the Node 40 business, we're trying to raise $12 million, I think, what would that cost me, like, normally, to go to investment banker, and both in the type of pick, which I don't want to start using a bunch of weird words, but by the time I pay them and they get their finder's fee on the commission, because they're going to charge a commission, unlike you, I don't think you charge a commission.
We're not charging.
There's no clip on the Raze itself. I mean, we're talking about a monster delta, right? Why don't you explore that? And you can use Node 40 if you want, and it'll explain to everybody why we went this way.
Yeah, exactly. So Node 40 is such a great example because you guys are not quite Series A, but you could if you wanted to, but it's not the right timing yet, but you're going to. So let me back up and answer your first question. The total addressable market here, or the size of this just in the US, is, forget the big number that most people know, and that is there's roughly around 5 million business applications for new businesses a year in the United States. That's mind-blowing alone. Most of that's small mom and pop and individual entrepreneurs and things like that. If you narrow it down based on the SEC's data and some other data sources, there's somewhere between 75,000 and 100,000 companies in the United States in private placement raising money. Private placement is a fancy term for not crowdfunding, not public companies. It's the big, huge market of what we call private fundraising. And it is also known as Reg D. It is everything from pre-seed rounds to Series B, C, D, et cetera. And a huge majority of that 2.6 trillion roughly private placement size, which is an enormous number, right? A huge majority of that money are your big private equity, your larger Series A deals. But fascinating enough is that the actual majority of the companies are not in that stage, right? So we get all that. So then when you narrow that down and you look at, there's tens of thousands of early stage companies fighting for capital, most of which are not going to be successful at all or somewhat successful. So you take a company like Node 40 that's much more mature, strong leadership team, and you guys are kind of working your way through the next rounds. You have to assume that even if you're not going to a Series A, you're spending somewhere in the neighborhood of 5 to 10% of your working capital, of that capital you're raising, I should say, to get that done. The average Reg D raise from seed round ish, pre-seed to seed round plus, is going to cost you about 30 grand. Based on all the numbers that are out there. Now, when you get to Series A plus, you could be spending 10 plus, 15%, 18%. I'm going to pick on crowdfunding for a minute. Crowdfunding is only $2 billion a year in capital raise. It's a baby, tiny industry, even though it gets so much attention. And yet it costs 18 to 22% of your capital that you raise. It's so expensive. Oh, it's ridiculous. Because you have to give up a bunch of money on the front end to the platforms. You also have to give up a percentage, but here's the secret. You also have to spend the money to advertise and find the retail investors to kick into your deal. And so it's incredibly expensive with low results. That's why they reject most of their applicants. So private placement is the wild, wild west in a way, in the sense that you can kind of do whatever you want. You can raise whatever you want. You just file a Form Reg D with the SEC. It's not really highly regulated, despite what people think, but it is so high friction and archaic, and it's really built for the big boys. And the high cost. Yet you've got all these companies thinking they can just download a save from Y Combinator and just start raising money on a simple agreement for future equity. And it's just not that easy.
Yeah. So you're talking about, if you raise $10 million, you think it's a $500,000 experience versus a Raze doing it. Like what would that cost a guy trying to raise 10 million?
If you went all in with our full IR service, you might spend like at most $5,000 to $10,000.
Yeah. I mean, am I mistaken, or would you encourage everyone at that stage to do the all-in Cadillac service? Because it's
you have to, unless you're a founder that can take a break from your business.
Yeah, that's the right answer. Yeah, you should pitch it to Perry, because I think I'd like to see what more value you guys could bring. Because man, it's not that. Well, I think that that's a great option for your customers, right? A premier service, and then just a block standard service to get your name out there. What are you finding? I mean, the arbitrage opportunity here, that's the way I look at almost everything, Brian. Arbitrage, or use a different word, is a gap between two marketplaces, like $500,000 in expenses versus, I think you charged us, what do you charge Node 40?
Well, almost everybody else comes in the front door for a couple $100 a month or $1,000. That's it. $1,000 a setup fee, or a couple $100 a month. And
so literally nothing stopping. Like the secretary could run through the process. You're only going to waste $200 if it doesn't fit it. It's actually a good experience, I would say, even if you're going to end up with the investment banker, which, have fun. On $12 million, that makes no sense. Okay, you're not even going to get a good investment banker to look at your business. That's the problem. I don't know why. I wish the government would make all this so much easier. It would not require. It's just another good example of the U.S. government and the regulators sticking their nose in business, and they are really harming business. I mean,
well, let me pick on that too. When in 2000, what was it, 12 or whatever, when they came out with the Jobs Act and stuff, and crowdfunding became legal, this is the stupid part that, of course, they did, is they actually put far more regulatory controls on the crowdfunding platforms, because they're like, we need to protect the retail investor. But they made it to where those guys made ridiculous money on the retail investors and the startups raising. So it's so ineffective, versus they should have just made it so much easier to crowdfund, right? That's why they're fighting all the crypto companies and all that stuff, right? you cannot you cannot crowdfund with a token right now in the United States. You go to jail. It's terrible. It's a bad deal. And we do need to protect people from the frauds and the altcoins and all that crap that went on. But some light regulatory friendly stuff to go into place to do some form of crowdfunding would go a long way to, I mean, we'd see an explosion of innovation. So yeah, we could get on that tangent forever.
Yeah, well, I just went. You probably know. You've probably seen this news, and I think a month ago I told you had spent 3 years dealing with the FTC. I've never even sold anything to a consumer, and we finally settled. I think yesterday or today. It cost me over $7 million. 3.5 years, a tremendous amount of disruption. I won't say that it caused our divorce and broke the family up, but it was definitely not helpful. And then really woke me up as to the value of governance and family businesses. Like, this is the problem with a family business. When you get a lawsuit like this, that, well, the statement that the FTC made, that they filed this in April of 2023, and we settled it yesterday. This has been going on 3.5 years. Okay, it's a little legal language use, a liberal use of the language. Oh yes, we filed on April, and the Cardones rolled over in 5 months later. No, 3.5 years later, I wanted to go to court because it was like it's literally, we have the government now. I think his name's Levine. Literally said that that Chargebacks 911 cannot stop a consumer from filing disputes for unwanted acquisitions of products online. Now it's an unwanted. Oh, I don't want it anymore. I'm gonna file a chargeback. I mean, they have no clue. It's really disappointing that the government has no clue. One, the financial implications of some of their decisions. They're interfering with rules and processes that have been set up for 20, 30 years. And then to add unwanted reminded me of the same thing that's going on in California and New York, where it's now no longer illegal to walk into a store and steal anything under $800. Okay, physically, you can be on film. 10 of you can do it as long as you don't take more than 800 each. Bang, bang. There's $8,000 going from Neiman Marcus. And the cops are like, hey, we can't afford to chase all these problems. If you don't think that's not happening online, yep. Right? And my point is, while we spent 3.5 years and $7 million, Terra Luna, FTX, and Celsius ripped billions of dollars away directly from Joe Consumer. This didn't even go through a third party. This was direct to the smallest consumers in the world. And we have our government spending 3.5 years on $100,000. Like, the fine was $100,000. I know. I must have gassed people. I mean, this is unbelievable, right? That the government would spend that kind of money. There's got to be some minimum. They go, hey, look, it's just not worth it. If they were catching all these other inefficient markets. And I'm getting back to where the subject. I think what you're doing is highly disruptive. I'm actually surprised that people aren't like sending you federal notices, because once you make this successful, it begins to act as a drip of water on the old system. And sooner or later, that drip will turn into a waterfall. And we're seeing it. We're seeing it in almost every industry. We're seeing change coming into the industry and then being slowed down. I don't know if you noticed that, right? It's difficult.
Well, the way I approached it is I actually got a couple of really just sharp attorneys that knew securities law, but one of them happened to be really well versed in blockchain. And I asked him, how can we thoughtfully use blockchain to do all these, provide all these benefits to early stage companies and raising money, but do it 100% legal by the book. And and not have to get into token issuances for, that are going to, cause everybody to have issues, right, on the regulatory side. And his exact answer, I'll never forget, was when I first met him at this event. He looked at me, he goes, actually, it's easy. He said, but nobody wants to do it. He was like, everybody wants to just scorch the earth and like, or do totally different things and then try to fight and fight and fight. Like, just let's start simple and let's just improve what's currently in place right now and provide those efficiencies. And you'll start to understand where you can really make a difference and really reduce the costs and the inefficiencies. Well, here, what I did is I went on the SEC's website, no joke, and I just read everything I could read about what their stance was about securities law around tokenization. And to my shocking surprise, they actually didn't have an issue with utility tokens, and they really didn't have any issues with doing a private release of a potential token. Where they had a real issue with was around what we would expect, and that is you can't just willy-nilly go around and sell tokens to just anybody and raise money. And so I just think that people just they just miss the whole point, which is, what are we trying to use this tech for? So sometimes our industry can be our worst enemy. I think we've always kind of noticed that and seen that with Web3. But I am with you. The faster we get closer to bumping along long-standing people in the industry, the more competition we're going to have and the more problems we're going to have. That's why we're actually partnering with people right now. We've got I can't talk about it right now, but I can announce the partnership. We have a very strategic partnership with Polymesh that we just put in place. And they're one of the few companies in the world that have figured out, building on the ERC 1400 standard, to essentially guarantee that when you release a token, it's regulatory friendly in the United States and Canada. And so we took their protocol, which is essentially like a layer one blockchain for security tokens, and we put it under our hood. And we're building that out right now, but we're partnering with some people that have regulatory licenses to change all this stuff, so that if a company wants to go raise with an equity token or a revenue token or a debt token, and they want to provide more liquidity in the future, and they want to really do some really cool stuff that is faster and cheaper, it means that you could raise $100,000 exactly the same price as you raised 10 million, because that's what we've already done with Raze. But this next advancement in our tech will take it to a whole new level.
Yeah, I mean, this has to be good for the smaller individual investor, maybe not big enough for a family office, maybe doesn't have all the little, bells and whistles, but right, somebody that wants to do it their own private equity. I mean, quite frankly, most people don't understand that seed, pre-seed, and A are the most profound investment returns in the world. Like there isn't any like B, C, D, and E. The reason these companies like buying into B, C's, like Dan Tapiro, if I called Dan tomorrow and said, Dan, I need $12 million and I want to do node 40, and you got 3 companies inside your whole fund that needs it, he's going to say, I need to deploy $50 to $100 million in cash, right? So I don't need $100 million. Couldn't spend $100 million. I mean, I could probably go buy all my other competitors because they raise money at stupid valuations. But most investors will never have access to this type of opportunity, right? To do a Series B or a seed series or early stage.
That's right.
I mean, that has to be good to give, as long as they're compliant and transparent, right? It has to be good for U.S. citizens to have access to markets that to date only venture capital, private equity, and super banks have had access to.
That's right. Well, yeah, and think about it now. Like my brother, he's a few years younger than me. He had a big exit. He sold his company to build a cybersecurity company. Sold his company to Booz Allen. Did really well with a couple other partners. And what did him and his partners, his buddies, do? They were like, well, after we get done sticking our money in some treasuries and savings, and we give our money to our family office, kind of safety net, we want to invest, right? And instead of giving all their money to their family office, they start poking around all these seed companies. They don't know, they have no idea where to put the money because the due diligence isn't there. It's a black box. They're investing and they have no idea. So when they saw Raze, they're like, well, shoot, this is amazing. Like, if you can get a bunch of deals on there that have due diligence and safety protections and accreditation check, at least we know the companies have done enough to do a proper offering, right? And not to mention all the other benefits. So I think we're going to see a new generation of that, millennial investor that starts to grow up, has some exits, has some working capital and money. They want to deploy 10, 20, 50, $100,000 at a time. And up until recently, it's just been either too high risk or impossible, not accessible to them. So I think there's another big benefit there.
Yeah. So maybe help me with something. I don't mean to set you up on this. I just don't know the answer. So that's not the intention. But, I stopped investing 20,000 here, 30,000 there, because the reporting is like so painful. I've got real estate deals. I think I got 5 different K1s to do every year. K1 is I got to fill out a form. I got to have the investment company, or like in the case of Grant Cardone Equities, for the real estate stuff, he sends me a note, and I got to reach out to him. Hey, I need my K1, man. My tax guy's freaking out. And then on my other stuff, I need K1s. Like, it's become now so painful that it's kind of like, I don't want to invest 100 grand in anything. My question to you is, hey, do you make that process easier for both the issuer, that is the company issuing stock in exchange for some other monetary value? Do they do the K1s, or do you kind of wrap that up in the app and it's just made available? If not, I think it's a good idea.
It's a great idea. We didn't tackle that right now. It's still up to the issuer, but it's something that we've really highly considered. I will say this: we give them plenty of data, more data than they would have it doing it on their own, to where it would be far easier. For example, when we did our taxes this year, by the way, we use Node 40. So it's big fan of that. But when our accountants did our taxes and they saw these investments, right, the investors coming in small and larger amounts, they're like, hey, we need the information on all these guys, right? We need to put all this together. We just went into our system and we exported the data and sent it over to them very simply and said, here's the name, here's their address. By the way, we had their KYC'd identity, meaning their proven identity, because that's our system does. We could prove that they were an accredited investor, and we knew their amount, the date they invested, and the currency they used, which is important now that we're dealing with digital assets, whether they use regular good old wire USD or whether they use their crypto to invest. And that is pretty powerful. So we don't have a tax service attached to it, but we've considered partnering on that potentially. We don't want to do everything, but it's a good opportunity.
Yeah, if we can help you, you might want to, next time you talk to Perry, we might be able to introduce you to some people. But I would think that would be something that would be easy to integrate into your system. It's just one of my pet peeves. I just hate it. But, I think of my sisters, right? This would be ideal for my sisters to access. They never see any of these deals, right? My most investors, if they're in equities, I actually don't think many people actually invest directly in equities anymore. I think they're all ETFs. And if you really know how Wall Street works, like I know this ETF on Bitcoin is going to be monsterly successful because I know how Wall Street sells products. Okay. My 80-year-old sister is going to be sold Bitcoin ETF. She will not have, she probably won't even hear about it. Okay. Literally, her advisor is just going to stick it in there. For the people that are asking questions, I think they're going to say, hey, you need the allocation. Okay. And they're going to, because it's going to be pre-packed. Look, Wall Street sells things. They don't wait for somebody to buy it. That's just a fact. And their commissions paid out on it. and they're going to be tiny little commissions, but it's going to be a monster amount of volume. And that's what makes me really comfortable with the ETF, because it's going to get sold, right? It's literally going to get pushed through the system, which I think is going to be another opportunity for you, because then you're going to, if that market works, and I think it will, people are going to be wanting to look at digital assets as a whole new space. And those digital asset guys like me that are going in this space, I don't want to use legacy tools. I don't want to be squeezed by the old legacy margin, which is, give me $500,000 and I might be your investment banker. Right. Give me $500,000 and let me disturb your life for the next, 8 months. You do all the work, explain your business to me, and then assuming everything's perfect in the marketplace, they're going to take me to the marketplace and we're going to have a great return. And then they're going to grab 5% of my company. It's just like, it's so much work. No guarantees. So I would encourage everyone that's looking at raising money to reach out to Brian and at least explore it, because for $1,000, at least it gets your nose into the M&A world, and you start to merger and acquisition world, and you start to understand, oh, there's a lot of lifting here. Because as you said, Brian, it is very, very interrupting to a core business that's running, right? That doesn't usually have a CFO, a seasoned CFO to go pitch. It's typically the CEO or the CTO, and it's extremely painful. It'd be easy if it would cost 30 grand. It'd be awesome. But it doesn't cost 30 grand. It costs a lot more time, energy, money. Who's the perfect client for you, man?
Any startup in that is getting, the earlier we can catch it, the better. The early meaning, the earlier we can catch the founder. Yeah, absolutely. Because
like no revenue at all.
Absolutely. A lot of our deals are no revenue, pre-seed, early stage, friends and family rounds. We have both extremes, seed plus, all in between. And the reason why I say that, now we kind of cap ourselves for now at, once they're in Series A, they're probably not going to see a need at this stage yet for us. But in the pre-seed to seed round stage, it's like the highest amount of friction is trying to figure out everything on your own and making all of those mistakes, right? And figuring all that. So we're just giving them this great script to say, do this, do this, do this, do this. If you need an attorney, here's some we can recommend. Don't do this. Like we just had somebody ask us, for example, hey, I want to go to market with a safe agreement, which we hear that 1,000 times, right? Everybody thinks they can use a safe, but I have an LLC.
Why don't you explain to the people that may not know what a safe agreement is, what it is?
It's a Y Combinator, which is a big accelerator out in the Valley, created something called the Simple Agreement for Future Equity. And it was a really innovative way to essentially accelerate the process.
Agreement for
future equity. Yeah, for equity.
SAFE.
And it was an innovative way for an early stage startups to not have to define their valuation, because when you're early stage, you have absolutely no idea what you're valued at. And so if you try to sell an investor you're worth 10 million and you have no revenue, they laugh at you. So they became very popular in the venture world, VC world. They've been around a long time. And the problem is they've seeped their way into almost every early stage founder's mindset, because founders are very crafty. They've learned, I don't have to pay a lawyer, and I can just set my terms and start doing a pitch deck and go to market and raise some money. And if you're part of that 2% that gets a VC check, good job. Congratulations. Now you got a whole nother problem because you have a VC on your cap table. But if you did that, great. But for everybody else, most, not all, but most angels are going to look at you like you have three heads when you're trying to pitch them a safe. It's just been my experience and a lot of other founder peers. So you have this safe agreement that sounds really cool and it's going to convert really good and it's supposed to protect both sides' interests, but there's no market appetite for it. And you're like, now what do I do? Right. So we get things like that.
So there's just a tiny little piece that's missing. So what Brian's saying is company wants to raise $10 million. It doesn't have enough metrics to justify the 10 million. So a guy like me says, hey, look, I can't pay you 10 million on that. Look, if you raise if you raise 8 of the 10 million at 10 million, I'll provide 2 of it. I'm going to price it at a discount to whatever that raise is in the future. See, that raise has not happened yet, but I'll do it at a discount, maybe 10, 15, 20% discount. If you raise it 30, you know, my $2 million basically moves from some other farm to a discount tied to that price of the other 8 million. Is that the way to look at a safe?
Exactly. And you can do a couple variations on it, you know, but ultimately it does. It's exactly what you said. And it's really nice because if you understand them and you can find a group of investors that like them, it is a great way to raise some early stage money. It's great. But like everything, it gets manipulated and abused and turned into something that it's not really intended for. And so we get these companies all the time that are like, I'm going to use a safe and my valuation cap is 10 million or 20 million or whatever. And then you look at their company and you're like, yeah, that's not probably going to work out well for you. Right? Or they're structured. Yeah.
Yeah. No, I didn't mean to interrupt you. I was going to ask you a question because in 2021, there was a lot of money raised on safes.
Oh, so much.
Like our biggest competitor raised at a $1.67 billion valuation. I think it was sub $10 million in revenue. They are so messed up now. I mean, they've laid off so many people, the entire management team. Here's an example of some accounting guys in Utah who, you know, they just caught the market at the very peak of mania when VCs were coming into the digital asset space, Bitcoin, crypto, blockchain. Quite frankly, I think the reason they were coming in, that was new money, not old Bitcoin money or alt money. It was legacy wealth looking to come into Bitcoin space. Bitcoin did not have an ETF. The regulators have slowed it down, delayed it, done everything they possibly can, but would allow a futures contract. Bizarre to me. And I think what the VCs and PE did was, hey, look, we know this money wants to come in this space. We're going to drive it into this space. Guess what they bought? FTX, Terra Luna, Celsius. They got blown out. And now everybody's walking around going, oh, wow, this is Bitcoin. That had nothing to do with Bitcoin. That is venture capital and regulators not doing the right things, prohibiting people from going through certain gates with their own risk capital. And it really pushes the volume somewhere else. VCs took advantage of that. My question to you is, if a tax bit, let's say, I'll just call their name out because it's just crazy amount of money, or Legible, or one of these guys that raised it, insane values. I'm buying a company, I'm giving a company $4 million on a $10 million valuation. The guy that did safes with TaxBit at 20% discount, and they go raise at $1.6 billion. That safe guy at a 20% discount is still grossly underwater, right? Like, how does he ever get out? I hate these safe deals. I want to know what I'm getting into, man.
Well, not only that, but the founders learn this later, but they're screwed. They lose. They're totally screwed. They won't own hardly any of their company
on the safe because the safe.
In your scenario, yeah, absolutely.
That's right.
You have to. I've met founders that have like 3 different versions of safes, and they're not really sure when anything's converting, and that's an example of it making it too easy, right? And too frictionless without any sort of controls or anything like that. And there wasn't a lot anybody could do about that. And there's nothing really can do about that. But the problem is that when a founder comes in and is trying to raise capital, this is why I said earlier stage, is that they come in, we're not going to give them legal advice, but we're going to tell them, okay, so if you stand up your deal, right? And you go pitch investors, how many investors do you have that are interested in your deal right now? And 9 out of 10 times it's like, not many. And it's like, that's problem number 1. Like, what are you pitching? What's your pitch deck look like? They may have to spend some money, but we are saving them a lot of heartache and a potentially failed business by just stopping them before they go do something that is probably going to ruin their opportunity to raise money.
Yeah, look, I think anybody even considering raising money, and I get nothing out of this comment. I don't get a backhander from Brian, so it's not uh $4,000, $2,000, $3,000. It actually starts you down the process. You can always unwind it and then go, okay, I'm going for I found the right investment banker, the guy that just really loves your business. The odds of that, by the way, are extremely low. And it's low because you may have a great friend at a VC or PE firm, but if they have bad investments from the last 18 months, which all of them do, they're not doing a new deal right now. They got to clean up all their bad trades. And if they do a deal with you, they're going to rip your head off because they're trying to make up for the last bad deal they did. These guys are extremely conservative people. Okay. Like VCs, private equity investment bankers, the most conservative people I've ever met in my life. I know you guys all think they're cowboys. They are like, do not risk any dollars whatsoever. It's you and me risking all the dollars. And so for me, it was a really good process just to learn for Node 40. Okay, cost me $1,500. Now we know what our pitch is. Is the pitch good? It's all in a data room. Speak to that a little bit. How do you help on the data room piece, Brian?
I would say well, at least our data that we've done and we've seen, 80% of founders don't know they need a data room or don't know what a data room is. And a data room is just a simple place to store all your due diligence docs for investors. And good, sophisticated or more educated investors are going to ask for that. Most venture capital are going to require it. And they're going to say, where are your financials? Where's your legal docs? They want to make sure you actually did form in Delaware or you did form in this state. They want to see who your team is. If you are a technical company, they want to see your white paper, right? You don't want to give all that stuff to just anybody. You don't want to publish that stuff. That's protected information. You're a private company. So you put it in a secure data room. And so what we do is we just give you a free data room as part of the process because we know you better have a data room. So that's included. And if you've already got one, you can just connect yours to ours. And I found that the simplest things like a data room are some of the most valuable for companies coming in. I didn't see that before, but I'm all focused on the tech and what we can do that's new. And I realized, gosh, everybody loves this data room and it's not that complicated, but that's.
No, it's not. But, you wouldn't expect an operating business to think about, hey, I need a data room. It's like, you know what I'm saying? I mean, only the most professional hunters in the world have a trophy room, right? It's not something you wake up in the morning and you go, okay, I'm a document entity and I've got this new software and it's going to, revolutionize documentation. Your expertise isn't, hey, I'm going to go build a data room with all the relevant material. I mean, Brian basically makes it easy. Hey, you need this, articles of incorporation. What are your bill of rights for the company? What do you do this? What's your attrition rate? What's your growth rate? And when somebody's packaged up, the first thing that an investor, including myself, will look for, how disorganized are these cats? Yep. Right? Or, the reason I ask how disorganized, because most of them are. Nobody ever says, well, how organized are they? The 1 out of 100 that's organized, the VC, a guy like me would be like, hey, wow, that's pretty cool. They have growth and they're organized. Unusual, right? I mean, I've literally walked into companies. In fact, I owned a company once. I couldn't get my partner to share data with guys throwing around $500 million. And the $500 million guy's like, hey, if you can't get me the data, I don't care how great you are. Why has it taken 2 weeks to get me a question on attrition? Right? That is really concerning to most people. If it's all packaged up, and Brian will do this, if it's packaged up, the data is going to be in there. And then they call you up and go, hey, there's 3 missing pieces of data I need. That fulfills our request. So right. It's like taking your car through a car wash, right? Really, what you provide is a really almost an automated way, at least to get the outside of your car clean. Whether you do the vacuum on the inside, right? That's a different, like whether you got a good business or not, it's a different thing. But you take care of all the stuff on the outside. I'm actually selling your product pretty good. I think
Yeah,
I
you did a great
understand
job.
it. Huh?
You did a great job, Gary. And I think there's one component to add to that, and this is a solution we're looking to get to. We don't have all the problems solved yet on it, but we have ideas on how we're going to do it. But I actually think a really big opportunity for Raze and for anybody else to solve is let's make it safe. Let's make it more transparent and safer for your investors post investment. Because what is that? What happens every time you make an investment? If you're an angel, at least you have absolutely no idea what's actually going on under the hood.
Right.
Except for financials, which can be very misleading as to how well the companies were being run. And so, yeah, you get your financial reports, but what about everything else? And so there's a real big opportunity there to not make these startups so black box. I call them black box, where you don't know what's going on inside. Technology on the blockchain gives our company the ability to do that. For example, this is a problem we'll have solved in January. No one will be able to say that they don't know. If they're an investor in Raze, in my company, no one will ever be able to say they don't know what's going on in the cap table, because it will be immutable. That's the stuff that we're rolling out, is where you can't jack around with your cap table without your investors knowing, or your key employees knowing. Things are being secured and reported on and transparent, still private. You don't want to give away your private data and information, but they're transparent enough to the people that need to know that. These are the things, like, this is embarrassing, but honestly, any founder that I know that isn't on one of these other more expensive cap table management software, they're literally managing their cap table on a spreadsheet.
Yep. I've
And
seen that. I've seen that.
So it's really interesting what's going on. And even with the more advanced cap table management solutions, it doesn't solve the problem that, in my opinion, what some of the tech we're working on. So I think this post-investment opportunity beyond just the cap table is a really big opportunity to solve, because the FTXs of the world, like you keep bringing that up, and it's such a great example. If they can get away with that, it's such a macro level for so long that nobody raises a red flag until it's too late. Imagine what the private markets are doing. Like, it's just crazy how little transparency there is in these companies.
Yeah. I think the regulators were sent a lot of emails about those three companies. A lot of emails. I mean, I know some of them, and somebody was sleeping at the wheel or getting paid. I mean, I'll just go ahead and say it. I'm probably going to get in trouble anyway. So, Brian, where do you see the company going? I mean, is this an IPO? Is this and when do you start raising money? And like, how big can this get?
So we definitely raised our money. We're actually about to complete our round right now. We've got just a little bit left on our round today. We're raising, but we have been.
How much?
We've raised all the money.
How
By
much?
the way, on the. Yeah, we've raised to date about $800,000, and we've done it all within inside of our platform, from the earliest MVP stage to today. We had to do it using our own stuff, right? Of course.
Yeah, of course.
And everything that we've rolled out, we've tried ourselves and done, and so we canned certain things that didn't work, et cetera. It's got to work for us for the most part. But as far as where we go, this is the exciting part for me, is that I don't see us going through a traditional Series A, Series B round,
I would hope not.
because if we do want to go raise, and we will need to go raise bigger money later, 5, 10, 20 million, whatever it is, we can do it all within our platform and within our service capability and offering, and save ourselves a lot of money and a lot of time, right? But show people how you can go from a pre-seed round, which is what we did, to potentially a Series A. And here's the real interesting part, and we do not have the solution yet on this, but we have our ideas, how we potentially could go to a public offering as well, whether it's Reg A Plus or a potential future to public token offering or something like that. We got to wait for the market to kind of work itself out. We're not in the public space, but the interesting things that we're working on right now will integrate eventually very nicely with the long-standing Reg A plus and public markets, if everything goes the way we all think it's going to go on the tokenization and blockchain side. So that is exciting for me because our pathway could be a public offering, but it's going to look very different than anybody else.
Who regulates your business inside the United States, assuming it's a stable entity?
So we fall inside a couple of areas. One, we're a pure SaaS company. Okay. So we're just like everybody else on the SaaS and services side. On the other side, when it comes to how certain controls work, how certain features work, FINRA and the SEC want to make sure that our services and software follow certain guidelines. And we do all that stuff. For example, we do accreditation checks through software for any kind of Regulation D offering, meaning if you're raising private money from accredited investors. We also do an extra layer, and we're not required to do this, but we do KYC and AML on investors that want to come in and deploy money to a startup. That guarantees that their identity has been verified on a US-based document, or if they're an international investor, that the company raising knows exactly who they are, and that document's been verified that it's real. And then FINRA, money transmitter, all that stuff, we're following things like that. So we just don't, eventually we may get some additional licenses if we have to, but we've stayed out of that world because we're trying to remain as a SaaS company today.
How many employees do you have today?
There's actually 4 of us that are full-time, and then we've got roughly about 5 to 7 contractors at any given time. We're very lean and mean and bootstrapped still as a company, but we've built, I come from the software world, so I've learned how to put fractional leaders in different roles at different stages as you're growing a company versus blowing all the investors' money in the first 3 months on salaries and all that stuff. And so we're pretty lean, but that's our team today.
Yeah, I see you being really disciplined and mature about, how you're approaching the problem. Some people go a little, they start to think the addressable market is the market. And it's like, no, that's just an addressable market. It doesn't mean that you're going to address it.
Right.
It's almost like, oh, we're going to take over the whole planet. And it's like, I'm pretty sure that's not going to happen. Especially these markets are going to be really different, right? There's going to be, like, I could see you growing into Series A very easy. Like, it's the same tools. Okay. You're just going to have a few zeros. Maybe some more security, some bells and whistles. Do you get concerned, or maybe when investors came in, was there any concern about regulatory exposure for your business, or do they just look
Absolutely.
at?
In fact, most of the earlier stage venture capital were scared to invest because this is so ironic, but they were investing in token projects.
Yeah.
I kid you not, but they were worried about our business. And we were doing everything by the book. But they were buying tokens up from other startups. And by the way, all those startups have gone to probably zero, and with their tokens at least. And so we have had investors concerned about that, mainly from a lack of education. But the right investors that have come in, especially the angels that invested in us, I haven't taken any VC money, by the way, to date. We've been open to it, but we've taken angels. They were angels that struggled with investing in startups and saw the value in this and said, this makes perfect sense to me. And when they went and deployed capital into Raze as an investor, they had such a good experience that they were like, well, I want to put more in. And so we've gone back to those folks and they've invested more in. My director of business development, Tim, who's on our website, he has been in the capital markets for 35 years, in the regulatory side, has had his Series 7 and all those other licenses. And he invested in Raze over a year ago. And he had he calls it a visceral experience because it was so against all of his training that he came on full time because he was like, this is amazing. This is going to disrupt everything.
Yeah. Well, he sees the amount of money that some of these guys are making, right? And it's like, whoa, if you can get this right, there's a lot of gaps to fill for sure.
Yes.
Do you think that market's really regulated well, Brian? The market with IPOs and venture capital, and I mean, does it look like one set of rules for the old guys and another set of rules for the new guys, or am I just being sensitive over my recent black eye?
This is the truth. Facts no cannot be disputed. There's so little regulation and controls on the venture capital companies, the corporations, the big money, on how they can deploy capital, what they do with their money, how they can pull money together, all that stuff. There's far less regulation on those guys and far more regulation on the everyday accredited investor. In fact, they're talking about raising the threshold again because of inflation, basically saying that, oh, no, you now have to have $500,000 in annual income instead of 300 or 200 or whatever. And so they're making it harder and harder to be an accredited investor, which means it's going to be easier and easier for the bigger guys to own those markets and deploy capital. So it means you have to force yourself into an institution to deploy your capital versus individual.
They're gonna own everyone. They own
Yeah.
all the businesses, but they also own all the investors because they have basically said, look, if you don't have $500,000, you're dumb. You shouldn't be able to make your own decisions. That is outrageous discrimination. Okay. The amount of discrimination coming from Washington, D.C. against big players versus small players. At every value, a piece of the value chain, it's really scary, man. I've never seen, I did not know this was our country.
Yeah.
I mean, really, I mean, it sounds, and that, so for me, that's this concern is a reason to support companies like you and the management team that are trying to push through this disruption, because this is very, very hard to do. Okay. For a guy to come in here on skinny amount of money, his whole career, he's been in this 2 years, raised 800 grand. He's trying to take on the New York Stock Exchange. Okay. NASDAQ and everybody. I mean, you looked at me like, not really, but everyone that feeds that complex, it's an institution. Okay. That institution is protected by the very people that make the money from that kind of, that whole industry. It's a multi-billion-dollar industry, if not trillions. And it's a club that's there to serve itself, right?
Gary, let me say this too. It's exactly why I had a lot of early stage investors ask me, why don't you just build this product and go sell it to all the institutions, the broker dealers and all that?
They
Like,
don't
yeah,
want
I'm like, yeah, that's a good idea, but that's a whole nother problem, right? And what we'd have to build and all that. And so I looked at the market, and his old Jeffrey Moore book that everybody's read, right? And it's like, you look at the market and you have to decide who your niche audience is going to be, your niche customer is going to be early stage. And I learned from this early on that it has to be big enough to make a massive difference to build a big company, but small enough early stage to not be noticed.
yeah,
And I looked at these pre-seed and seed rounds companies, and I was like, nobody cares about them. Like the VCs care about them, yes. Okay, they're investing in them. But in regards to disrupting how this is done, I'm not pissing off JP Morgan. I'm not pissing off BlackRock. I'm a flea to them, right? But if we do something really amazing in the early stage, we'll have the capital and we will have the know-how and the team behind us and the lawyers and everything you need to then start inching into what we call the traditional Series A private equity and stuff a couple years down the road or whenever it ends up being. But we don't have to tackle that right now.
yeah,
So we got to get it right.
yeah. So got a couple of minutes left. So you've done your raise. What are you gonna deploy the funds for, and when do you think you would do another raise, if at all?
So we bootstrapped this. We didn't go traditional and raise 800 in 2 months and then go to work. We built the MVP, then raised a couple 100,000 on the MVP, which was pretty fun experience. And then we just trickled in and started raising more as we went in kind of quarterly installments. So I just did everything differently because it's just how our business needed to grow. I didn't care what other people were doing. So we've got enough runway to kind of go into, middle of next year and keep healthy and keep growing and keep investing. But where we're going is we know we're going to need a lot of money to scale. We know we're not going to need a lot of money for things like security and software development. We're a software company, so we got to keep innovating in that area.
Mm.
Next year definitely is target for Series A for us. I mean, that's like we gotta go there, or some form of a traditional larger raise is what I will call it, not necessarily Series A. And at that stage, we're going. It's funny when you talk about the TAM, the total addressable market. For us to go to 0.001% to 1.5% or 0.9%, the numbers are astronomically huge from a revenue perspective for us, especially on the margin side. But we've only tackled 1%, less than 1% of the startup
So
side.
in 2 years, if you were to tap into half of that 1% market, how much revenue does the company look at?
We probably would be around $5 to $8 million of revenue a year with roughly 40% margins,
Right.
because we're a SaaS business.
That's at 0.5% penetration.
Yeah, and
US
that doesn't
market only.
count international, by the way, which we've already started taking on, because international looks the same as domestic in our platform.
Yeah, and the US international firms have more challenges raising money, I think.
Oh yeah.
I mean, the regulation alone.
Well, what's surprising, I don't know the stat on this, I'd love to know it, but the number of Delaware corporations that are really international startups is astounding. There's Dubai money coming in, Asian money coming in. They're setting up Delaware corporations. They're actually raising money, building cool product, cool companies, but they're really international teams.
Yeah. Who would be your closest competitor?
So traditionally, people get us confused with crowdfunding platforms, the Start Engines and Republics of the world. And sometimes we run into those guys because they're involved in a lot of private raises and stuff like that, even though we're not crowdfunding. We traditionally get thrown into the angel list world, but angel list is syndicates, SPVs, and all that stuff.
But they should be your friends, right?
Yeah.
Like Florida funders should love you, right? They don't have to go hunt deals. I mean, I'm not picking on them, but
yeah, no, they've actually put in, I would call it a high touch, high services model, right? Low tech. We think there's a lot of opportunity there as well. Competition can also get thrown around the broker dealer space. It just depends, Gary, what we're talking about, and that's part of the challenge here. But I would say from a platform perspective, you got a list of companies. From a services perspective, it's a whole nother list. But really what we're trying to do is create a different product category, because that creates a little bit more, much more of a blue ocean for us to really tap into and really do things differently, for people to come into our platform and just deploy differently. And then we don't have to be compared so much. We actually play really well, to your point, to a lot of other companies, because an angel group can work really well with us. Even a broker dealer, we have an integrated broker dealer partnership, an investment bank partnership, where when they're high enough and they need that extra level of introduction, we will make that intro to those guys and they'll run with the race. It's much more expensive, but they do a great job.
Yeah, for sure. Look, at the end of the day, when you get close to the hole, you're more interested in sinking the putt than you are like, oh, did I save every dime? There does come a point in time when you go, hey, look, let's get it done. Brian, I think what you're doing is really cool. You're in the early stages of it. Anybody that's not following this cat should, because you're going to be able to watch an entrepreneur build a business. It won't be easy. He knows it won't be easy. He's pretty tough. Not as tough as is G, but he's not as old as I am. So I've got so much. Like for me, I look at this and go, my God, what you're doing. If you can last the journey, because these guys will like pull a lot of little sneaky things, delays, tactics. That like your ability to deliver the results. It's it could be a year and a half off, just because what you're trying to change. You're trying to take 3 zeros off the cost of raising money. 3 to 4 zeros. Okay. So that's a lot of money that, like I talk about, Circle makes $70 million a month in ticks on stable coins. This is a company that nobody had ever heard of 5 years ago. The problem is JP Morgan would hate that $70 million. And you and I look at it and go, oh, $800 million a year, $840 million a year. Yeah, at margins that are paper thin, and a public company that has a bunch of analysts looking at their income streams, they don't want to show a margin dilution, right? They don't want to show, oh, wow, because it's a signal of, hey, JP Morgan, this is where all these spreads are going. They're going to get crushed. So they stop it, right? They don't want this type of technology because the gap this isn't going to happen.
Yep.
For sure, we will be buying companies in a decade in this manner online like we buy at Amazon.
Yep.
I believe that. So well done to you for spotting the opportunity. Where do people reach out to you at, sir?
Raze.finance is a great place to start because you can register as an investor to check out our deals for free if you're accredited. And then number two, if you are looking at raising capital or currently raising, just fill out the quick form. We're very responsive, very nimble. We'll get in touch with you right away. We want to talk to you. We're actually a very high touch business still in that regard. We got a lot of automation and things like that, but we talk to every single founder before they come on our platform. It's important to us because it's a big deal for them to go out and raise money. So that's where they can check us out. We're, of course, on LinkedIn and Twitter. Those are our two social spaces. And again, it's raze.finance.
And Brian Anderson, right?
Yes, Brian Anderson.
As in the Matrix Anderson.
Exactly. I heard that a long time.
Anderson. I'm sure you've heard that all the time, but it is a great, hey, you could have a lot worse. At least they're not asking you, are you Grant? Every day, 3 times a day.
I feel sorry. Yeah, that's terrible.
Brian and I were having dinner one night, and I'm like, yeah, hey, look, we're probably going to get interrupted within the 2 hours. He didn't know what I was saying. And then after the dinner, he's like, Jesus Christ, dude, how often does this happen? I'm like, yeah, I'm a pretty good sport about it.
You're a great sport of it, man, because I've been to a couple of networking and social functions where you've been there, and you are flawless, man. It's like you don't even skip a beat.
Well, it's not their fault that we look alike. Can't really blame them. And it's not their fault that my brother's a big mouth. So, well, listen, I've really enjoyed this. You guys are located where, by the way? Little plug for our local town here.
Yeah, so we're technically in Bradenton, Florida, because a bunch of us are there. My CFO's there. I'm here, which is close to Sarasota, Florida. And then we've got a bunch of people around the country.
Yeah, I was trying to get him to say that he's in the St. Pete, Tampa blockchain alley where I live. And I think everybody's going to end up here, but literally he's right over the bridge right there. Yeah. I could probably throw a baseball at you if I had a good shoulder left. Yep. It's been awesome chatting.
Gary.
Yeah, it's been awesome chatting. I wish you really great success, and I'm really excited about your raise. Make sure you tell Perry, because he'll be like, oh, really? How'd you do that? And anytime I can help you, man, let me know, please.
Thank you, Gary. I really appreciate your time. Thanks for doing this for us.
All right, buddy. Enjoyed it.
All right.
Ciao.